Imagine this for a moment. It's Saturday, February 14th, 2026, Valentine's Day. While couples across the world are busy posting photos, buying roses, and pretending calories don't count today, the financial markets decided to hand investors a very different shade of red. Not romance red, portfolio red. The kind of red that makes your stomach drop when you open your trading app. On Thursday night, just as Asian markets were shutting down ahead of the Lunar New Year break, traders logging off, desks emptying, liquidity slowly draining out of the system, something snapped on the western side of the world. Algorithms went wild. Within hours, silver didn't just dip, it collapsed. Over 10% wiped out in a single brutal move, plunging all the way down near $75 an ounce. Stops got smashed, margin calls triggered, positions vaporized, and gold followed right behind it. Nearly $150 vanished in what felt like minutes, blowing straight through what many people thought was an unbreakable $5,000 floor. Charts look less like markets and more like accident reports. Now, if you're staring at your portfolio right now and your heartbeat feels faster than usual, take a breath. Seriously, put the phone down for a second. Step away from the chart. Don't scream at the screen. Because what you just witnessed is not the collapse of the financial system, and it's not the death of precious metals. What you saw was something far more mechanical. A liquidity vacuum. A classic Wall Street maneuver that happens when big money finds itself in an empty room and decides to rearrange the furniture before anyone else walks back in. Before we go further, be honest. Did you panic yesterday and hit the sell button? Or did you look at the drop and think, nice, discount sale? And where are you watching this from right now? New York? London? Dubai? Maybe you're stuck in an airport somewhere scrolling charts while waiting for your flight to Singapore or Bangkok. Drop it in the comments. But now, close your other tabs. Ignore the screaming headlines predicting financial apocalypse. Because what just happened might actually turn out to be the funniest math mistake markets make all year. So let's ask the real question. Why did the floors suddenly disappear? Turn on any financial news channel, and you'll hear dramatic explanations. According to them, the sell-off happened because of a leaked memo supposedly coming out of Russia hinting at peace negotiations and some form of return to dollar-based settlements. Sounds dramatic. Perfect headline material. Spies, politics, global power shifts. But let's be honest, that explanation is mostly nonsense. The truth is much less exciting, but much more important. And it lives inside something traders call value at risk, or VAR. This is the invisible rulebook controlling nearly every major trading desk on the planet. Forget politics for a moment. Forget headlines. Strip away all the noise and look at the math. Every major bank, JP Morgan, Goldman Sachs, European trading houses, hedge funds in London and New York, runs on risk models. These systems calculate exactly how much money a desk is allowed to lose on a bad day. And here's the key. These limits are not suggestions. They are enforced automatically. A trader cannot simply ignore them because he feels bullish. The system forces action. Let's rewind 1 year. Gold was trading around $2,600 an ounce. Silver was around $28. Prices were lower, volatility was calmer, and banks could comfortably hold large positions without risk alarms going off. Fast forward to now. Gold near $5,000. Silver pushing toward $80. Prices doubled. Positions became heavier. And volatility, the speed at which prices swing, exploded. Silver's volatility, on an annualized basis, shot toward extreme levels. And when volatility spikes, risk models panic. The system suddenly looks at positions and says, wait, this trade is now too dangerous. A small move against us could cause massive losses. And once that happens, the computers don't ask opinions. They issue orders. Reduce risk. Sell positions. Cut exposure. Imagine a bank trader who was allowed to hold 100 silver contracts when price was $28. At $75 with higher volatility, the same rules might only allow him to hold 40 contracts. So what happens? He must dump 60 contracts. Not because he hates silver. Not because fundamentals changed overnight. Because the spreadsheet told him to. Now multiply this across thousands of desks, funds, and algorithms all running similar models. They all see higher prices. They all see higher volatility. And they all hit the reduce risk button at nearly the same time. This creates a feedback loop. Selling pushes prices down. Falling prices increase volatility. Higher volatility triggers more forced selling, which pushes prices down even further. A self-feeding spiral. And on Thursday night, that spiral found itself in a dangerously empty market. Liquidity was already thinning as Asia prepared for holidays. Fewer buyers were around to absorb big sell orders. So when institutional selling hit, prices fell fast. And this wasn't retail panic selling 5 ounces of silver. This was institutional size. Thousands of contracts slamming into bids in a market with nobody home. Machines cleaning their books before liquidity disappeared for 10 days. And timing here matters. Because starting this weekend, the Shanghai Gold Exchange, one of the biggest centers of physical metal demand, shuts down for Lunar New Year celebrations. China, the world's largest physical buyer, steps away. Western banks know this. If they need to unload risk, they must do it before buyers disappear. Wait too long, and there's nobody left to take the other side of the trade. So they flush positions early. And once silver broke technical levels, momentum funds piled in. Trend-following algorithms don't analyze. They chase movement. Price drops, they sell more. But here's where the story becomes interesting. Because while the paper price was collapsing on screens, something very different was happening in the real world. And that's where part 2 begins. Now here's the part most people completely miss. While traders were watching red candles explode across their screens, something very different was happening behind the scenes, in the physical market. Because while paper traders were dumping contracts, real metal was quietly leaving vaults. According to warehouse data released after the sell-off, millions of ounces of physical silver were withdrawn in a single day. Trucks literally showed up to vault facilities, loaded metal, and moved it out. Think about how strange that is. The price is crashing, headlines scream nobody wants silver, and yet physical metal is being taken out of storage at massive scale. That's the disconnect. The paper market is selling because risk models force liquidation. The physical market is buying because real industries still need the metal. Factories don't run on futures contracts. Solar manufacturers don't build panels using paper trades. Electronics producers don't wire circuits with headlines. They need real metal. And when prices fall, they restock. This is the fracture between financial markets and the physical economy. On the screen, price says demand vanished. In reality, physical buyers are saying, "Thank you for the discount." When you see prices drop sharply while vault inventories shrink, that's not a true bear market. That's ownership changing hands. Weak hands get shaken out. Strong hands quietly accumulate. And there's another layer here most retail traders never hear about. The structure of the futures market itself. Normally, commodities trade in something called contango, meaning future prices are slightly higher than today's price. That makes sense because storing metal costs money. But parts of the silver market have been slipping into backwardation, meaning buyers are willing to pay more for metal today than for delivery in the future. That usually signals tight supply. It's the market's way of saying, we need material now. So think about the contradiction. Prices crash while supply signals show tightness. That's not normal. That's what happens when paper trading pressure temporarily overwhelms real-world demand. And timing again matters. This move happened right as China steps away for holiday. One of the largest physical buyers leaves the market for 10 days. Liquidity disappears. Perfect moment for banks and funds to reduce positions and clean their books. Now let's talk about the story the media used to explain all this. Because whenever markets move violently, financial news needs a villain. They can't go on air and say, risk models forced banks to sell positions due to volatility calculations. That's boring. Nobody clicks on that. So instead, we got a dramatic geopolitical narrative. A supposed leaked memo suggesting Russia might move back toward dollar settlement as part of peace negotiations. Sounds huge, right? But step back for a moment. For years, global trade blocs have been trying to move away from dollar dependency. Central banks have been stacking gold. Countries have been building alternative payment systems. And suddenly, one rumor is supposed to reverse that entire trend overnight? Highly unlikely. But algorithms don't debate politics. They scan headlines for keywords. Peace deal, sell safe havens. Dollar strength, sell commodities. The moment those headlines hit news feeds, machines reacted instantly. Selling pressure that was already building got an excuse. And once selling starts, stops get triggered leverage unwinds, and price falls faster than logic can catch up. By the time officials came out calling the rumor unlikely, the damage was already done. Stops hit. Positions liquidated. Weak hands gone. This trick is older than modern markets. Release a dramatic headline in a thin market and moves accelerate. And remember, markets were thin because Asia was heading into holiday mode. So what were central banks doing while traders panicked? Buying. Because central banks don't trade based on price swings. They operate on policy shifts and long-term strategy. Many central banks have been steadily increasing gold reserves for years now. They're thinking decades ahead, not next week. A sudden drop in price doesn't scare them. It gives them better entry points. This is the difference between short-term speculation and long-term strategy. The West largely trades leverage and paper contracts. The East often focuses on physical accumulation. When prices crash, leverage traders celebrate short-term wins. Meanwhile, physical buyers simply place larger orders. Ownership transfers quietly. So when headlines scream that safe haven demand is gone, ask yourself a simple question. If nobody wants the metal, why are vault inventories shrinking? Why are physical deliveries increasing? The answer is simple. Paper traders are selling risk. Real-world users are buying supply. And this flush likely aimed to break technical momentum before Asian markets return and liquidity normalizes. Which brings us to the most important point of all. Because beyond headlines, politics, and trading models, there's something markets can't fake forever. Physical reality. And that's where part 3 takes us. Away from trading desks and into the industrial world where silver isn't a trade. It's a necessity. Now let's leave trading floors, rumor mills, and algorithm battles behind for a moment. Let's step into the real economy. Factories, power plants, data centers, defense systems, technology production lines. Places where materials are not symbols on screens, they're physical necessities. Because no matter what price flashes on a chart, you cannot print silver. You have to mine it. And mining isn't keeping up. While paper traders were busy liquidating positions, the industrial world didn't suddenly stop needing silver. Solar panels didn't stop being installed. Electric vehicles didn't suddenly switch materials. AI data centers didn't decide they could operate without conductive components. Silver holds a unique role. It's both a monetary metal and an industrial metal. It protects wealth during uncertainty, yes, but it is also one of the most important industrial inputs in modern technology. It's the most conductive metal available. That's physics, not opinion. And that means if the world wants renewable energy, electric transportation, advanced electronics, defense technology, and massive computing infrastructure, it needs silver. A lot of it. Here's the uncomfortable truth most bears ignore. For several consecutive years, global silver consumption has exceeded global production. In plain terms, the world is using more silver than it mines. Every year, industrial demand and investment demand eat into above-ground inventories. Those stockpiles shrink quietly while prices bounce around based on trading flows. And supply isn't something you can magically increase overnight. Opening a new mine takes years. Environmental approvals, financing, construction, logistics. It's a decade-long process in many cases. Meanwhile, demand keeps climbing. Solar installations grow. Electronics consumption expands. Electric vehicles multiply. Defense systems grow more technologically complex. And artificial intelligence infrastructure requires enormous hardware expansion, all dependent on conductive materials. Demand is rising. Supply is stagnant. Basic economics would normally suggest higher prices over time. But financial markets don't always move according to fundamentals in the short term. They move according to liquidity, leverage, and positioning, which is exactly what we just witnessed. Now let's talk about something that confuses many investors: warehouse inventory categories. People see reports showing metal moving from registered inventory to eligible inventory and immediately jump to conspiracy theories. But often, the explanation is more practical than dramatic. Registered metal is ready for immediate futures delivery. Eligible metal is still in the vault, but not currently assigned for delivery. When storage costs or interest rates change, large traders sometimes move metal between categories simply to reduce storage expenses or optimize financing strategies. It's accounting efficiency, not necessarily manipulation. However, the larger message remains: physical metal continues moving. delivery continues happening. And when large quantities leave vaults during price weakness, that suggests strong hands are accumulating supply. Because industries and sovereign buyers don't operate on fear. They operate on necessity and long-term planning. And there's another important structural signal many people overlook. When future prices trade below current prices, something known as backwardation, markets are effectively saying supply today is more valuable than supply tomorrow. That rarely happens unless there's tightness in physical availability. If metal were abundant, future prices would always include storage and financing costs, keeping them higher than spot prices. But when markets fear future shortages, they pay premiums for immediate supply. And that's the signal quietly flashing behind the scenes. So what does all of this mean for you? It means Thursday's crash was less about fundamentals and more about mechanics. Risk models forced banks to lighten positions. Algorithms reacted to headlines. Liquidity vanished ahead of holidays. Stops got triggered. Leverage unwound. And in the middle of all that chaos, physical buyers stepped in. Ownership shifted. Weak hands exited. Strong hands accumulated. And now here we are on Valentine's Day, staring at charts painted red, wondering if something broke. But maybe nothing broke. Maybe markets simply had one of their periodic emotional breakdowns. Because remember, if you bought silver at $25 or $30, you're still sitting comfortably above those levels even after the drop. If you chased price near recent highs, you just learned a brutal lesson about volatility. And volatility is the price of admission in commodities. But fundamentals didn't change overnight. Solar panels still require silver. Electronics still require silver. Defense systems still consume silver permanently. Mining supply still struggles to keep pace. So before you divorce your investment because of one ugly day, consider what actually happened. This wasn't a fundamental collapse. It was a math-driven liquidation event. Paper markets can panic, but physical reality doesn't disappear. The algorithms will keep fighting each other tomorrow. Traders will keep chasing headlines. But once Asian markets reopen and normal liquidity returns, price discovery continues again. So maybe the best move right now isn't to stare at charts all weekend. Turn off the screen. Go enjoy dinner. Spend time with someone you care about. Let the machines argue over contracts while real metal quietly moves where it's actually needed. Because when the dust settles, fundamentals still matter. Stay calm, stay informed, and stay safe.